30 to 40 minutes with a further 10 to 15 minutes at the end for any questions that you may have. For all of you dialing in, you will be muted for the duration of the call. So if you do have any questions, please send it to us via the Q&A button at the bottom of your screen, and we'll address those questions at the end. Hopefully we'll have time to answer all of your questions today, but if time does get the better of us, we will endeavour to get back to you after the session, so please leave us with your contact details. Okay, so firstly, we're going to look at the basics of equity release. There should be another slide coming up here now. Excellent. So we'll look at what equity release is, the different types of schemes that are available, how the interest rates and payment options work. We'll consider the ownership situation of the property, how you repay the loan, and finally, the potential impact on inheritance tax. So, firstly, what is equity release? Well, when you're planning for retirement, or indeed if you're already in retirement, because there have been so many changes over the years, it's become more important than ever to consider all of your financial options. And equity release is having a much more important role to play in the financial planning process. However, in most cases, they are misunderstood or even overlooked completely. So for most of us, our house is not only our home, it's generally our largest asset. And most of us become rather attached to our homes, and sometimes the prospect of moving to a new house, in a new area, with new neighbours, particularly as we get older, is not always desirable. Historically, releasing equity from your home could only be achieved through what was known as a home reversion plan. And this involves immediately giving up ownership of all or part of your home. This meant that the deeds and ownership of the property will be transferred to the home reversion plan provider, but you would be able to remain in the property rent-free for the remainder of your lifetime or until you had to go into long-term care. So that's where the option of equity release through a lifetime mortgage can be considered. This gives you the ability to raise funds against the value of your property via a mortgage, whilst continuing to live in, and more importantly, retaining ownership of your home. And because you retain 100% ownership of your property, there's no uncertainty in the future regarding repossessions or eviction. Unlike residential mortgages, interest payments are not required to be made on equity release mortgages. Instead, the interest simply rolls up over the term of the loan, and the total amount, including the original capital borrowed, is then repaid either at the end of your lifetime or again if you move into long-term residential care. The loan is usually repaid from the proceeds of the house sale. Now, equity release have two basic formats. The first being a lump sum roll-up mortgage, where the maximum available lump sum is taken as a one-off release of capital. And the other option is a drawdown plan, where an initial drawdown amount is taken and then further funds are available in reserve if they're required in the future. The interest rate is generally fixed at outset and for the life of the loan, which means that there are no ongoing affordability issues. The fixed rate also makes it very easy to forecast how much you will owe at any one time in the future. And I have an example to show you a little bit later. So negative equity and inheritance. So there's no question of your beneficiaries ever inheriting a debt. All equity release providers offer a no negative equity guarantee, which essentially means that you will never have to pay back more than the property is sold for. There are also schemes available which allow you to ring fence a portion of the property value, and this could be useful if you wanted to ensure that a minimum amount of capital is left to your beneficiaries upon your death. So this can be seen as an inheritance guarantee, if you like. But what we also have to take account of is that house prices will be expected to continue to rise over the longer term, which would go some way to offset the effect of the interest charged. Again, I'll demonstrate this in my example shortly. Finally, for peace of mind, all equity release providers are regulated by the Financial Conduct Authority, the FCA, with most lenders also subscribing to the Equity Release Council's Voluntary Code of Practice. For advisors, in addition to the standard industry qualifications and regulation by the FCA, they must also have achieved a specific qualification in respect of equity release and lifetime mortgages. At Birchwood, we have several expert advisors in this field, so you can be sure of a great service and also a best advice process. So, is equity release suitable for me? Well, simply, if you are over the age of 55 and own your own home, equity release is available for you to consider. For jointly owned properties, the youngest person on the deeds must be age 55 or over, be UK resident, and the property must be your principal residence and fit the lender's criteria. Houses, flats, maisonettes, they're all considered, and the minimum loan amount is just £10,000. And if you do wish to consider equity release further, this must be done in conjunction with regulated advice from a company or individual with the relevant qualifications, as I've just mentioned. So, some might say that equity release is just a last resort for people who haven't planned properly for their retirement and are desperate for money. But there are many different people in different situations that consider equity release. And rather than being a last resort scenario, I think on the contrary, it has become a very important part of the holistic financial planning process. So, how much equity can be released? Well, this is generally based on your age and the value of your property. And you can see from the example on the screen here, this is an example of a 72-year-old individual, has a property valued at 400,000, and they could typically apply for a loan of 30% of that value, which is around 120,000. Interest rates are typically between 2 and 3% currently. Interest rates are an all-time low. So between 2 and 3% is quite attractive. And so if we take that £120,000 loan, we'll assume the higher level of interest at 3%, and the outstanding balance after 10 years would be £161,000. So £41,000 worth of interest has been added over the 10-year period. But as I mentioned, we also have to take account of a rise in property prices. And if we considered or assumed a modest 1.5% average annual increase in the house value, bearing in mind that the UK average over the last 10 years has been 3%, although you owe £41,000 more on your home, the value of the property has increased by £64,000 over that period. So that hasn't actually impacted the value of your estate. So what can we use the capital for? That's on the next slide. It can be used for any purpose at all. Okay, so you can clear any existing debts that you may have built up, or repay your existing mortgage. And if you opt to do this, because no repayments are required on a lifetime mortgage, this will also save on the monthly repayments. You can also use the capital to enhance or improve your lifestyle on a day-to-day basis, where many of us will have ambitions when we retire, large purchases such as new cars, maybe home improvements, and could also include more extensive travel plans. And this can all be funded through equity release. You might want to provide gifts to family members, maybe even help to fund them the cost of a wedding or education fees, or even help them onto the property ladder themselves. This approach can be seen as desirable as it is seen as an early inheritance. And with this approach, you get to see the benefits of gifting the capital during your lifetime. And finally, you could potentially reduce inheritance tax. Firstly, the mortgage acts as a debt to the estate upon death, which in itself will reduce any inheritance tax payable. And if you didn't want to use the funds for any purpose already mentioned, you could consider placing the capital into a trust arrangement, which would segment the capital from your estate in the future. As I mentioned, my colleague Lee will explain a little bit about trusts shortly. That really covers the basics of equity release, and what I find is that as well as the information that I've covered here, these are the most frequently asked questions that we come up against. So I'll look to tackle these. So if you want to move home, that's no problem. All lifetime mortgages are portable and transferable, providing the new property is suitable and meets the criteria of the lender. And the loan will also need to match the lender's loan to value ratios. This can usually be done without any further cost. Will I still own my home? Absolutely. You are still 100% the legal owner of the property. The lifetime mortgage provider simply secures a loan against your home in much the same way as you would with a traditional mortgage, with a caveat that it must be repaid upon the earlier occurrence of your death or upon moving into a long-term care arrangement. The loan can be repaid at any time, although early redemption charges may apply in the early years, and this will differ from scheme to scheme and lender to lender. Most lenders allow you to make a payment equal to 10% of the outstanding balance every year with no early repayment charge, if you wish. And if you do have a mortgage already, yes, you do still qualify. Lifetime mortgages can be used to repay your existing residential mortgage, and as no monthly payments are required, no affordability checks are made by the lenders. This also means it could be seen as not only a good way to release capital, but it could also result in reducing your monthly outgoings, leaving you with more disposable income. In terms of costs, unlike most conventional mortgages, there's very little in terms of upfront costs associated with equity release. Most providers offer schemes with no arrangement fees, and most include free valuations. You may have to pay a fee to your advisor. However, at Birchwood, we do not charge any upfront advice fees. Our remuneration will come directly from whichever lender we choose to provide the mortgage. On this point, it's also important that your advisor can access the whole of market when advising on equity release. And at Birchwood, as I mentioned, we are independent financial advisors, and as such, we have access to every lender that may be suitable to you without exception. Typically, the only cost to you as the borrower would be for your legal representation, so the solicitor undertaking the conveyancing work, and that cost will vary depending on the firm you choose and the property type. For instance, a leasehold property such as a flat or a maisonette is likely to be more expensive than a standard freehold house due to the additional work that is usually associated with leases. So should you consult your family? Well, any discussions and subsequent decisions you make surrounding equity release should ideally involve members of your immediate family and or your future beneficiaries wherever possible. If your main priority is to gift, by discussing the situation with your family, you can quantify whether your children or grandchildren actually need the capital and also for what purpose. And also, if all of your children or beneficiaries are involved in the process and the subsequent decision, this approach can stop any disagreements later on down the line. Where possible, a nominated member of your family should also be party to any meetings and discussions with your advisor. And at Birchwood, we would actively encourage you to do this. So finally, how can equity release assist with inheritance tax planning? Well, as I mentioned earlier, equity release should no longer be seen as a last resort or something that is only used by those who haven't planned properly for their retirement. Equity release should be seen as an integral part of the financial planning process for retirement rather than as a backup plan. And it can also be used to mitigate inheritance tax upon death. Some people may worry that by using equity release, they're reducing the amount of potential inheritance that may be left. However, if you have concerns over the amount of inheritance tax that you may have to pay, the equity release mortgage itself and any accrued interest will be treated as a debt to the estate at the point of death, and therefore the total outstanding loan will be free from inheritance tax. As I mentioned previously, a further way to potentially mitigate the inheritance tax due would be to consider placing a portion of the released funds into a trust arrangement, which under current legislation could fall out of your estate completely for inheritance tax purposes after 7 years. Now, there are various types of different trusts available for you to consider, and I'm going to pass on to Lee now, who's going to explain a little bit more on trusts and discounted gift trusts. Thank you.
Yeah, thank you, Darren. So good morning, everybody, and thanks for joining us today. I've looked and it's nice to see some familiar names on the attendee list. I'm Lee, and I'm going to take you through some of the key points relating to trusts. I'm also going to take a closer look at a particular type of trust known as a discounted gift trust and how it differs to more regular trusts. In addition to the above, I'll provide an overview on inheritance tax. I'll also show you a worked example and cover off some of the advantages and disadvantages. In the previous slides, Darren touched on how you could use equity release to raise capital and reduce a potential inheritance tax bill by creating a debt against the estate. The example I will use expands on that by considering placing the capital raised via equity release into a trust. There are a number of alternative planning tools we could use, some being more relevant to your personal circumstances than others. So to reiterate Darren's point from earlier, we do encourage you to speak to your advisor. So first off, inheritance tax. I trust the slides moved on for everyone. So more and more families are finding themselves in a situation where their assets are subject to quite a punitive inheritance tax bill. Inheritance tax is the tax you pay on any assets which exceed the available exemptions or reliefs when you die. The assets include everything you own, your home, possessions, money, and any investments. This is all covered by the term estate. Any assets valued over the available reliefs and exemptions will likely be taxed at 40%. And any gifts that you make in the 7 years before your death would still be included in the inheritance tax calculation. But there is a reduction in the charge from the 4th year, and the tax is removed entirely after the 7th year. Most people would prefer to avoid paying this tax where possible, maximising the assets available to the family, and try to do so by gifting assets away during their lifetime. Unfortunately, not everyone is able to do that. So you may need the assets to live off or provide an income. Even if you give the assets away but retain the option to have them back or continue to make use of them, they will be treated as a gift with reservation and will still be included in your estate. Fortunately, there is a solution to avoid the gift with reservation rules, which I've already mentioned, and that's the discounted gift trust. But before I talk about that, what is a trust? We've all probably heard the term trust used in several different contexts, and there are several different types of trust, all with different features and uses. A trust is created during an individual's lifetime or on death via a will or intestacy. It is usually written and imposes rules which must be followed. This is known as the trust deed. In simple terms, a trust is an arrangement that allows someone to transfer assets out of their estate to a third party to look after on behalf of recipients. So the three parties involved in a trust are the personal persons gifting into the trust, they're known as the settlers, and they will decide at outset how the assets in a trust should be looked after and who they are for. Again, this is set out in the trust deed. Once the assets are gifted into the trust, the settlers are no longer the legal owners. The legal owners of the assets are known as the trustees. Their role is to deal with the assets as set out in the deed or will, manage the trust on a day-to-day basis, pay any tax due, and decide how to invest or make best use of the assets for the benefit of the beneficiaries. If the trustees change, the trust can continue, but there must always be at least one trustee. Finally, the beneficiary is the person or persons who benefit from the trust. There might be more than one beneficiary, like a whole family, or a defined group of people, for example, all grandchildren, including unborn. So not something I don't imagine many of you have asked yourself before, but how can a trust be structured? There are two common ways to structure a trust, either bare or discretionary. A bare trust will require a specific beneficiary to be named at outset, and it will allow them to access the trust on death of the settler. The beneficiary can never be changed regardless of what might happen in the future, and typically the beneficiary becomes entitled to the assets at 18 years old. A discretionary trust offers more flexibility and will allow beneficiaries to be amended whilst giving complete discretion to the trustees as to when the beneficiary can access the funds. So the structure is important as it impacts many aspects, but especially the tax treatment, the access and the control. But other than inheritance tax, why would you use a trust? The first point is managing the assets. Trusts can be flexible, allowing you to tailor them to your needs. And through a trust, assets can be distributed to the beneficiaries over time. The second point, protecting the assets, is quite a key one. Placing assets in certain types of trust, so discretionary trusts, can protect them from creditors, marriage breakdown, or from those who might want to influence the beneficiaries. A trust can only offer that protection if the beneficiary has no right to the proceeds until the trustees appoint them, So as a beneficiary is fully entitled to proceeds under a bare trust, there is no protection. Point 3, flexibility. Using a trust allows assets to be held for minor children and allows control as to how and when the benefits are paid out if a settler is concerned about the maturity of the beneficiary. For example, the trust can be set to pay out when a certain age is reached or a stage in their life. For example, when a child goes to university, gets married, or purchases their first property. Finally, trusts can avoid probate. As assets within a trust don't belong to the settler, in the event of their death, the value of the asset is not necessarily included in the estate for probate, which can mean substantial savings in time, legal fees, and paperwork. Any investments within a trust may be able to pay the death benefits quicker, as they can pay the trustees, who are the legal owners, and don't require the grant of representation. This can all happen in a matter of weeks. As mentioned, in some but not all cases, placing assets into a trust would usually mean that the individual gifting the assets has no further access to them, especially if the aim of the trust is to mitigate or reduce exposure to inheritance tax. There is a specific type of trust that does allow access whilst removing assets from the estate. So let's look a little bit closer at that special kind of trust we've mentioned and find out what a discounted gift trust is. So it's a trust-based inheritance tax planning arrangement for individuals who wish to undertake some inheritance tax planning, but who are unable or unwilling to lose full access to their investment. A discounted gift trust usually comprises of a lump sum investment made into an investment vehicle known as an investment bond, which is then wrapped within the trust. Provided the settler or settlers are in reasonable health, a calculation is made of the likely total income that will be paid out during their lifetime. The value of this income is where the term discount applies. It is calculated considering factors such as age, health, and the level of withdrawal requested. The discounted value is the amount the estate will be immediately reduced by, resulting in an immediate inheritance tax benefit. The residual discounted gift will fall out of the estate in 7 years. The amount of the discount for inheritance tax purposes may be less than anticipated, as the actual discount can only be confirmed by HMRC after death. Due to the investment vehicle used, and provided the income is set up correctly, income tax can be mitigated for the duration of the trust. The income will then cease on the death of the settlers. The settlers will automatically become trustees of the trust, but they can elect to add additional trustees if they want to. This would be particularly useful for grandparents, as an example, who are setting up a trust for the benefit of grandchildren, as they may wish to include the parents as additional trustees so that the trust can continue should anything happen to them before the beneficiaries reach an appropriate age. Coupled with the inheritance tax planning benefits, the ability to withdraw a lifelong income without falling foul of those gift with reservation rules is incredibly valuable. So quite a lot of information there. So let's do an example to bring it all to life. So Darren's chap from earlier, who was 72 years of age, has taken £120,000 from his property through equity release. He's spent £20,000 and then gifts £100,000 into a discounted gift trust. He would like £5,000 per year from the trust to top up his pension, and the trust providers have calculated a relatively short life expectancy of 9 years based on the medical information he has provided. This means 5% of the 5% income is multiplied by 9 years, giving a total discount of £45,000. The client starts taking his income from the fund, and £45,000 is immediately fallen outside of his estate for inheritance tax purposes. The remaining £55,000 of the gift will fall outside of the estate in 7 years. So hopefully that does bring everything to life for you. And the next one, so talk about some advantages and disadvantages. So firstly, the advantage of it is it allows an inheritance tax effective transfer. So the settlers fund or discount is seen to fall outside of the estate immediately, and as mentioned, the residual fund falls outside the estate in 7 years. Any inheritance tax charge on the residual gift will start reducing after year 3, which we've covered earlier. The second point allows the settlers to access the gift through a pre-selected payment stream. So despite gifting the funds into the trust and effectively moving them from their estate, the settlers can still benefit from a regular income from the trust. Again, particularly useful for those who have estates that exceed inheritance tax thresholds and wish to supplement their retirement income. The next point, it may attract a significant discount. So depending on the estimated life expectancy of the settler, the discount could have an immediate, the discount will have an immediate inheritance tax benefit. And the final point is it's tried and tested with HMRC and it does work. The disadvantages are relatively inflexible. So once the trust is in place, there is very little that can be amended, particularly for a bare trust. As an example of that, the payment stream can't be changed. The discount is based on the level of withdrawals required, spread over the life expectancy of the settler. Therefore, once the discount has been agreed, the income levels cannot be changed for the entire life of the trust. Excuse me. It is imperative that the income received from the trust is spent, as you will not reduce the inheritance tax liability if the withdrawals you receive from the trust are accumulating in your bank account. The next point, payments are generally capped so as not to exceed 5% of the gift. This is due to the tax treatment of the underlying investment, the investment bond, which even though is in a trust, will have the normal tax rules applied. Therefore, in order to avoid any immediate income tax calculations, the regular withdrawals must not exceed that 5% of the initial investment. And the final point is that the value of any unit-linked contract is not guaranteed, as the prices of units fluctuates on a daily basis, as I'm sure many of you have seen in your normal portfolios. So that's all from me. I appreciate quite complex subjects, so I'll try to run through a few of the basic points and give you a general feel for how trusts operate and the potential uses, how discount gift trust can be used to plan against inheritance tax, and also how it can be used effectively in conjunction with equity release. Of course, we would not expect this webinar to provide you with all of the answers, so please contact us again if there's anything you wish to discuss further. And we'll now hand back to Darren for some Q&A.
Thank you, Lee. Yes, there's been a couple of questions, so thank you for those of you that have asked these. Some around this very similar subject. We're talking about why only on your principal residence is equity release available, and can it work on a second home? So conventional equity release plans are exclusively for main residences, because the lender will require the capital to be paid back at some point, and they'll obviously base their lending on perceived life expectancy or the inability to remain living in the property. Having said that, there are a small amount of providers that offer loans on second properties, although you're going to have lower loan to value ratios and higher interest rates. So essentially, you're not going to be able to borrow as much as the conventional equity release scheme, and you will end up paying that little bit more on the interest rate as well. So yes, whilst they're not the norm on second properties, you know, they can be available. So again, if that's something that you have an interest in, please do get in contact. And you know, it's all about your own individual circumstances. And if it's something that we can assist you with, then we absolutely will. So there's another question in respect of age of spouse. So if you have a younger spouse, if you have a spouse who is under 55, no, this is not going to work if you are both on the deeds of the property until your spouse is 55. And the how does the age difference affect the calculation? Well, this is a calculation made by the lenders in terms of, again, assessing your life expectancy, and they will assess the life expectancy of the younger spouse in order to you know, to set the interest rate and the loan to value as well. So that is something that is done by the lender. Lenders, it does differ from lender to lender. Some are slightly more generous in how much they want to lend, but yeah, it's based on the age of the youngest person. So let's have a look at this. Equity release, are gifts still subject to inheritance tax annual limits? Yes, maybe Lee might pick up on this in a second, but yes, they would be. However, if you are placing large amounts of capital into a trust, that will be seen as a potentially exempt transfer. So this is probably more commonly known as a 7-year rule, where after 7 years, the capital will fall out of your estate for inheritance tax completely, and that is on a tiered level currently, although that is something we're expecting to change very soon.
Breakdown, was that the lifetime gifting annual exemption that they were talking
Yes, yeah. So I'm assuming that means the £3,000 annual limit.
Yeah, so yeah, the annual exemption, provided you haven't used it elsewhere, you will get £3,000 from this year. You can carry forward £3,000 from the previous year, and if it's a joint gift, for example, your spouse will then be able to gift the £6,000, so £3,000 each, provided nothing was gifted in the previous year.
Okay, I think there's a couple of questions around trusts, Lee.
So I've just seen one that what's the impact of care costs on the equity release and discounted gift trust? So obviously the equity release mortgage will be the first debt against the property, so that will not be able to necessarily be used for care costs. And the discounted gift trust will form an income which will be considered when they're doing the care cost calculations. And obviously different thresholds apply in that area. So again, we can talk about that more privately if you have concerns about care and how this impacts it.
Mm-hmm. Yes, I believe a copy of the slides would be available, although there is also a recording of the webinar that's going to be made available shortly as well, in answer to that question.
Okay, next one, percent return, would you expect the discounted gift trust to generate? So the return is, again, it's a personal thing depending on sort of how we set the trust up. The underlying investment vehicle will produce growth, hopefully, and that depends on how risky it is and how it's set up. So I couldn't give you a percentage return specifically, but as mentioned, you want to keep any return that you do get under that 5% because of the underlying tax treatment of the investment bond that's within the discounted gift trust. So it would be capped to 5% of that, irrespective of what the actual performance of the funds within the bond are.
Okay, just looking through these questions, Lee.
Okay, so yeah, I can see them as well. So what happens to the DGT on death of the settlers? So the income will, when both of the settlers or the settler passes away, the income will stop immediately, and the trust can remain for the beneficiaries. So that will keep ticking along, and depending on how the trust is set up, the trustees will either dissolve the trust or keep it going. Got another question about placing a second home into a discounted gift trust. Quite simply, I just think that's no. I've had another comment or question. So yes, this is probably one for you, Dan, but the mortgage rates, the percentages on equity release are historically quite low. And that's probably why you're hearing a lot more about it now than you would have done in the past. Mm-hmm. And that's across the board, not just equity release mortgages, regular mortgages as well, but yeah, specifically equity release in this example.
Yeah, and again, this would depend on age, it would depend on loan to value, but I think I've used the bracket of between 2 and 3%. Some slightly below, I've seen them 1 point something, and also 3 point something. So it's a very fast moving landscape, as it is with with all standard mortgages as well. So but I think if we were looking at applying for something today, I'd be confident we could get something under 3%, depending on circumstances, obviously, that has to come into it.
In the trust example, what happens if the gentleman lives longer than 9 years? So yes, the income continues until death. It doesn't just stop after the 9 years. The 9 years is only used when calculating the discount on the discounted gift trust. But once that 9 years is over, income that was set up at the start will continue indefinitely, well, until the settlers pass away. So yeah, the 5k will continue. What will happen is, if the income isn't set up correctly at the start, then there is every chance that the income will use up the entire value of the underlying bond. So yeah, the performance of the bond is a factor, and what happens underneath. So yeah, to follow up on the second part of that question, the 5k can't necessarily continue indefinitely if the performance of the bond is not great.
Okay, there's a question in respect of, would it be better to put a life policy in trust rather than equity release? Again, circumstances may dictate. The equity release capital is released without an ongoing commitment in terms of the monthly payment, where if you had a life policy, that would be funded from your expenditure. Again, there are arguments both ways, and again, individual circumstance will dictate, which would be the better option for you.
Yeah, I mean, in the example we gave, the chap needed £120,000. He spent £20,000 of it. Whereas if you're gifting a life policy into trust, typically you're paying premiums either monthly or yearly on the policy. So actually you've got an outgoing expense rather than extra income. So that's the reason we're talking about putting the equity release funds into the trust, because it suited this particular chap's circumstances. In that case, in another case, it might be that putting a life policy into trust is the better solution for the individual. But again, like Darren says, it comes down to personal circumstances.
Just making sure we haven't missed anything off, Lee.
Yeah, we've covered off the interest rates, which is the question that I can see there. Could you gift the income that you draw from the trust to your family without any tax implications? Quite a difficult one, because the actual income from the trust, once it's set up, will be seen as a return of capital and not necessarily an income. So, provided you're using your annual exemptions, the £3,000, you can gift it away. Anything over and above that starts getting complicated if the income from the trust is where you are gifting from. Yeah. If you have a natural pension income, for example, and you can evidence that the money that you're gifting away doesn't impact your lifestyle, then there would be no tax implications. But again, it's quite a difficult situation, and everyone will be slightly different. So we'd have to run through that again in person.
Yeah, and it's something really that is, if we look into enhanced lifestyle in our later years, spending does become very much an option. Yeah, take on board what Lee said there. I think the last one, Lee, is in respect of tax.
Yeah, again, so getting quite complex. Excuse me. Yeah. Some of these questions, and it's all going to be down to the individual. But in a discounted gift trust, who is responsible for paying the income tax? So the responsibility will fall on the trustees. It depends on the setup. So whether it's a discretionary gift trust, a discretionary discounted gift trust, or bare discounted gift trust. But yeah, the income tax will largely be dealt with by trustees if the income is realised in the bond and within the trust. The trustees will be responsible if the bond segments. Again, this is complex, but if the bond segments are assigned to beneficiaries or sellers, then they are treated as responsible for the income tax. So, quite a complex situation. So I tried to make it a bit more straightforward there, but probably haven't done. So yeah, looking through, I think
that's it. Just one further point on the mortgage rates, which I think we've probably covered, but yes, equity release interest rates, like interest rates across the board, Bank of England base rate is down at 0.1%, all-time historic low, expected to remain that way for some time in view of the current situation we find ourselves in. And so, yeah, it does, or it can make equity release more attractive than it perhaps was, 5 years ago when interest rates were slightly higher, but certainly the interest rates on equity release then were pushing 6 and 7%. So we're now around sort of, between 2 and 3, I think, comfortably. So yes, it can be more attractive. This is not a push on equity release products by any stretch. This is giving some information, and everybody's situation is different, and there's just some things that that you can consider.
One question that we did cover off before this that I get asked about is ill health. So something we covered off before. Ill health will impact both the equity release mortgage and the discounted gift trust. If depending on your sort of how bad it is, as we've mentioned, that will impact the life expectancy and therefore the discount that you get on the discounted gift trust. And on the equity release side of things, I'm sure Darren will cover this off for you, but again, it will mean that you get an enhanced amount potentially for the equity release.
Yeah, I think for equity release, if there is a proven shortened lifespan, then the loan to value ratios could be enhanced. Whether it would be hugely enhanced, it's hard to say, again, depending on age. But yeah, that is, again, is something that if this whole situation is of interest, then it is something that we can run through, the different variables. As I mentioned, most of you are already clients. We're happily look into this situation for you, and as ever, give you the best advice based on your circumstances. Okay, it looks like, unless you can see any that we've missed, Lee, that we've covered off the questions.
We covered everything. Yep.
On the Q&A. Okay, and so guys, if there is anything that you want to take up with us, myself or Lee, or your advisor at Birchwood, if you don't have a nominated advisor at Birchwood and you would like to get in touch, there is an info@birchwoodinvestment.com that you can send an inquiry to, and myself, Lee, or one of our colleagues will happily get back to you. Thanks again for joining us, and hope that's been useful for you, and we look forward to seeing you all in person very soon. Take care.
Thanks, guys. Bye-bye.